So now, Trump presidency 2.0. I've readjusted the arrows. I've made it so that everything's kind of back to what it was before because we don't know really what's happening right now. As I said before, if we look at the analytics of what's going on right now, matter of fact, I have to tell you, when I was putting together the Wealth Advisor review for this month, until just a day or so ago, I couldn't figure out what to talk about because the fact is, if I look at the technicals, they're just all over the place. And I said it before, we follow a number of people for both technical and fundamental information. Some of them are convinced we're about to go into the next depression. Some of them are convinced we're going to see another great recession like 2008. Some of them are convinced it's a great buying opportunity. And then there's a myriad of other answers in between. So I really couldn't come to you and say, definitively, this is what I think we're doing right now. We're watching like everybody else is. But what I can tell you at this point in time, and every day reveals new information, every week, every month reveals new information. That's what we're watching for. But I would have to say that when I look at the current economy that President Trump has to work with, outside of the havoc created by this whole tariff turmoil, we have strong profit margins still. And there was no reason, as Conrad de Quadros says, we had no reason to expect recession in 2025. And maybe these tariffs will create part of that discussion, but at this point, everything seems strong regarding corporate profits. When we look at the U.S. Federal Reserve's target rate on Fed funds, still reasonable to work with, 4.25 to 4.5%. 10-year treasuries are reasonable. They kind of bumped up a little bit here recently because of everybody trying to buy into them, but again, not anything great yet, and we think they're going to come down as far as the rate goes. March 25, unemployment. We produced 228,000 jobs last Friday at least that's what they told us for the month of March. It's fantastic. That's not recessionary type job production. Fundamentally, the U.S. economy currently remains strong and could be strengthened in the long term by an efficacious deployment of the Trump tariff policies 2.0. Technically, the U.S. stock market may experience volatility and short-term drawdowns from the uncertainty created by the same Trump administration and tariffs 2.0. And so that's what we're watching here, is to see, is this a correction? Is it a bear market? Is it a full market reset like the Great Depression or the Great Recession? And all that information is hanging out there waiting for us to have enough time to be able to gather it together. Let me do it this way with you. Rather than looking at this slide, I'm going to actually go to the live. So first things first, the fear and greed index right now, it's extreme fear right now. And I understand that. I don't want to make light about it, but there is just a lot of fearfulness out there. All you have to do is watch any of the newscasts, podcasts, anybody talking about technical trading, talking about markets. It's just, there's a lot of discomfort. And so there's extreme fear. Previous was 4. That's where we are today. A week ago was 15 on the score. 17 was about a month ago. 64 was a year ago. So we're over in here. So people were feeling much better back then than they are now. That's a problem. It definitely is an issue. If you're ever interested, we might actually spend some time on talking about this in a future one, but normally it's not where I go for that discussion. What I normally go to is right here. And this is looking at the S&P 500, looking at the last 6 months. And you can see here from the high that we had before in February 19th to the low we're at, it looked like we had formed a bottom here. I thought we had went up, hit the 200-day moving average. That's what this red line is. Turned around, headed south. Then President Trump shared his thoughts on the tariffs, and here's what we've seen recently. And to be fair, the market is just trying to assess this, the economy, trying to figure out what is this going to look like? What is China going to do? What are other nations going to do? You may have heard, I read today that the Trump administration says that roughly 50 countries have approached them saying, we'd like to renegotiate our trade policy with you to make it so that it's far more functional. And some of them talking zero tariffs. You also have China, who pushed back and said, we're going to increase your tariff and Trump, your tariff rates. And Trump came back and said, if you do, this is what's going to happen. And so we'll see. But to be fair, that's what happened last time around. China raised their tariff rates. President Trump did his as well. We survived. And to that point, I'm going to just share with you one other thing. Oh, goodness gracious. I thought I had it open here. Well, let me do it here. So if we look at There we go. So the Shanghai Stock Index. So this is their index. This is China's. You could also look at the Hong Kong as well, but they're both the same. They have dropped below their 200-day moving average as well, because their nation is just as concerned about this fight as any. As a matter of fact, there's a lot of data that shows that China is going through a lot of financial problems. The reason we don't see it quite so much is because they're more centralized in how they handle things. The government gives businesses loans. The government gives loans to people. The government controls a lot of different pieces that the United States doesn't do. And so consequently, they can hide some of this turmoil better than what a free nation can. Having said that, though, their stock market is in a free fall as well and is very concerned about what's happening also, which to that point, I've heard said by multiple people, in a trade war like this, the United States is in the best position, meaning that it hurts others more than it hurts us for this trade war to happen. And while it would hurt us, it would hurt others more. And so that's every reason in the world for them to decide to work with us and to move forward intelligently. Having said that, it doesn't change the fact that we're feeling that pain and that fear here. But I would say that we're only 4 days into this now. It's going to take a little bit of time, but I think over the next week, 2 weeks, 3 weeks, we're going to find out how many nations actually came to the table and said, hey, we want to renegotiate. We got a plan here. We'll work with you. And who stands up and says, we're fighting. If it's a European Union, Macron says, we're going to fight, and then turns around and says something different. We'll see. We'll see. The next few weeks are going to show us a lot. One of the things that we watch carefully, this is the VIX. The VIX is a measurement of volatility on the Chicago Board of Exchange. The VVIX is a measurement of volatility on the VIX. And so if I pulled back and showed you, you could see that it's been a pretty good indicator of the volatility that we have coming. So when the VVIX, the orange line, is much higher than the VIX, it means we got a lot more volatility coming. Another way to kind of see this is if we just make so the VIX is a straight line, you can see that we are probably going to experience some more volatility. I probably didn't have to tell you that. You probably already knew that. I'm just telling you the data supports that we are, but don't let it worry you because we're expecting it. And what we'll do is make decisions along the way because we're proactive wherever we can be, and we're looking for opportunities, like whether the US dollar is going down, so that might be an investment opportunity. Whether precious metals are going up, that might be another opportunity. They pulled back quite a bit, that might be an opportunity. We're looking for opportunities to be proactive wherever possible. And then reactive, if things go south in a really bad way, which you've heard me talk about this before, how we handled the pandemic, how we handled 2022, how we handled 2008. We're here doing that same thing again this time as well. And then finally, if we look at the sectors, and this is looking for the last 5 days, you can see that some of the sectors have done well. We can see that, for instance, staples continue to do well. We can see, and these are all defensive kind of positions. Where are you up there? There we go. Healthcare is doing well. Utilities, real estate, although real estate's kind of turned down a bit. Surprising, didn't think it would do so well, to be honest, but has discretionary actually has been up a bit. I think people they can't help themselves a bit sometimes, but I don't expect that to be a great defensive position. Communication services, these are all areas in the last 5 days that have held their own against the S&P 500. I think that depending on how this late term cycle goes, we'll be able to choose how to get more defensive or more aggressive, depending on what comes out of this, which is instead of trying to predict what's going to happen, being patient and reacting appropriately when the information shows itself.